Hello everyone, myself Prezi. Welcome back to my channel, Commerce Class. Fund flow statement, meaning and definition of fund flow statement, flow of fund, meaning of fund, preparation of fund flow statement, schedule of changes in working capital, calculation of fund from operation, etc. are explained in this video. Financial statements, that is balance sheet and profit and loss account, shows the net effect of various transactions. Balance sheet is the summary of asset and liability and shows the financial status of the company. Then profit and loss account reflects the result of business operations for the period of time, and it contains summary of expense incurred and revenue realized in an accounting period. Both statements provide essential basic information on financial activities of business. But balance sheet does not disclose the causes for changes in assets and liabilities between two different points of time. At the same time, there are many transactions that take place in an undertaking and which do not operate through profit and loss account. Thus, another statement has to be prepared to show the changes in assets and liabilities from the end of one period of time to the end of another period of time. So, such statement is called statement of changes in financial position or fund flow statement. Before moving to fund flow statement, I would like to discuss about concept of fund. Funds has been defined in a number of ways. In narrow sense, it means cash. In broad sense, fund refers to the money value in whatever form it may exist. Fund means all financial resources used in business, whether in the form of men, material, money, machinery, or others. Men, machinery, materials, etc. are used in a firm for production and other activities of business, and company has to pay wages and salary to the human resources. Then for acquiring material, equipments, etc., for purchasing material and machinery, etc., firm has to pay certain amount. So fund means all financial resources which is used in business, whether in the form of men, material, money, machinery, etc. In popular sense, fund means working capital, that is excess of current asset over current liability. In fund flow statement, fund means working capital, excess of current asset over current liability. Working capital is the capital which is used to meet the day-to-day activities of business. Fund flow statement is a method which is used to study the changes in financial position of business enterprises between beginning and ending financial statement dates. From current year or previous year's figure, we usually analyzes the changes in financial position, and it's a statement showing source and uses of fund for a period of time. It describes the sources from which additional funds were derived and used to which these funds were put. That is, from where firm get funds and how it uses its fund. Firm get fund by issue of shares, debentures, then sale of long-term investments, then sale of fixed asset, etc. And firm uses this fund to pay dividend, tax, and to purchase long-term investment, fixed asset, and to make payment to the preference shareholders and debenture holders at the time of redemption of preference shares and debentures. And fund flow statement indicates various means by which funds have been obtained during certain period and the ways to which these funds have been used during that period. The statement contains all details of financial resources which have become available during accounting period, and it shows amount raised from various sources of finance during the year and the uses of these fund. And it's a very useful tool in analyzing financial statement because which analyzes changes taken place between two balance sheet dates. Now we will move to the features of fund flow statement. Fund flow statement is one of the important management tool for decision making. Fund flow statement shows the changes of financial position, and it shows the sources of fund and uses of fund. So we use this financial statement for decision making purpose. And the statement is prepared taking into account revenue statement and position statement of organization. So for preparing fund flow statement, we need balance sheet and profit and loss account. Revenue statement is profit and loss account and position statement is balance sheet. Next, it is comparative analytical statement between two consecutive years. Here fund flow statement is an analytical statement because it shows uses of fund and application of fund and how firms raise fund and how it utilizes its fund. The next one, its statement reveals the fund inflows and outflows during accounting period. So fund flow statement shows inflow of fund and outflow of fund. Inflow means source of fund and outflow means application of fund. In order to measure the soundness and solvency of business, preparation of fund flow is a must. So fund flow statement is used to measure the soundness of business and solvency of business. Then by preparing fund flow statement, management will be able to know how much funds are available and where exactly they can be deployed. We know that fund flow statement is a statement showing source and application of fund. The last one, it's a statement which portrays the source from which funds are obtained and uses to which they are being put. So these are the features of fund flow statement. What is flow of fund? Flow of fund means inward and outward movement of fund of an enterprise. We know that fund means working capital. So flow means movement or change. So flow of fund means inflow and outflow of fund or movement or changes in working capital. If the effect of transaction results in increase of fund, it is called source of fund. If it results in the decrease of fund, it is known as application of fund or outflow of fund. So flow means movement or inflow and outflow. So flow of fund means transfer of economic value from one asset of equity to another, and it is the movement of fund in working capital or inflow and outflow of fund. Rule of flow of fund. Flow of fund occurs when a transaction changes on one hand a non-current account and on another hand a current account. All current asset and current liabilities comes under current account. All fixed liability and fixed assets comes under non-current account. So when a change in non-current account is followed by change in another non-current account, does not amount to flow of fund. In this case, neither the working capital increases nor decreases. When change in one current account results in a change in another current account, it does not affect fund. There must be one current account and one non-current account in a transaction. Then only it is treated as flow of fund. That is, funds move when a transaction affects current asset and fixed asset. Here, the transaction, both current item and non-current item is there, so it is flow of fund. And second one, a fixed and current liability. Here fixed is non-current item and current liability is current item. And third one, current asset and fixed liability. Here current asset is current account related to current account and fixed liability is related to non-current item. Then fixed liability and current liability. One is non-current and other is current account. These all results flow of fund. Fund do not move when the transaction affects fixed asset and fixed liability or current asset and current liability. Transactions which involves two current item or two non-current item does not result flow of fund. There must be one current item and other non-current item. Procedure for preparing fund flow statement. Preparation of fund flow statement consists of two parts: statement of or schedule of changes in working capital, then second one, statement of source and application of fund. First one, statement of changes in working capital. We know that working capital is the excess of current asset over current liability. Working capital is equal to current asset minus current liability. This statement is prepared to show the changes in working capital between two balance sheet dates. Changes in amount of current asset and current liability in current balance sheet as compared with previous balance sheet, which results increase or decrease in working capital. If the current asset in current period is more than previous period, the effect is increase in working capital. If current liability in current period is more than previous period, that the effect is decrease in working capital and that is recorded in decrease column. The total increase or total decrease are compared and difference shows net increase and net decrease in working capital. So the rule of statement of changes in working capital. First one, increase in current asset increases working capital, decrease in current asset decreases working capital. An increase in current liability decreases working capital, decrease in current liability increases working capital. For example, stock. Stock is a current asset. Then previous year's figure is 10,000 and current year's figure is 15,000. So there is an increase in stock, increase of 5,000, and that results increase in working capital, because we know that working capital is the difference between current asset and current liability. Current asset increases, working capital will also increases. If current asset decreases, working capital also decreases. There is a direct relationship between current asset and working capital. Suppose total current asset is 2 lakh and current liability is 1 lakh. So the working capital is difference between current asset and current liability, and working capital is 1 lakh. And in that example, there is an increase of 5,000. So current asset will also increases and current asset will be 2,05,000, and the difference is 1,05,000. Difference is working capital, it is 1,05,000. Earlier it was 1 lakh. When stock increases, working capital also increases. Then current liability. Increase in current liability decreases working capital, and decrease in current liability increases working capital. Inverse relationship between current liability and working capital. For example, creditor. It's a current liability. In previous year it is 10,000 and current year it is 20,000. There is an increase of 10,000. And last year's working capital 1 lakh. In that example, current asset is 2 lakh and current liability is 1 lakh. And in this year, there is an increase of current liability. There is a increase of 10,000 and current liability increases. Amount is 1 lakh 10,000. Then working capital is 2 lakh minus 1 lakh 10,000 and working capital is 90,000. So, working capital decreases due to the increase in current liability. So, current liability and working capital shows inverse relationship. An increase in current liability decreases working capital. Decrease in current liability increases working capital. Then pro forma of statement of changes in working capital. Here we have to draw 5 columns. First column particulars, second column previous year, then third column current year, and fourth column increase in working capital, then last column decrease in working capital. Then first item, current asset. Write all current assets in particulars column. Then write previous year's figure in previous year column. Then current year's figure in current year column. Then find out increase or decrease in current asset. If there is increase, please write that increased amount in increase column. Then if it is decrease, please write decreased amount in decrease column. Then current liability. Write all current liability in particulars column and find out increase or decrease in current liability. Then third step is calculation of working capital. Working capital is the difference between current asset and current liability. So find out total of current asset and total of current liability. Difference of current asset and current liability is working capital. So we will get previous year's working capital and current year's working capital. Then find out increase or decrease in working capital. If current year's working capital is 20,000 and previous year's working capital is 10,000, there is an increase in working capital. Increase of 10,000 in working capital. Current year's working capital is 30,000 and previous year's figure is 50,000. So previous year's working capital is more than current year's. So there is decrease in working capital. Net increase or decrease in working capital result of statement of changes in working capital, and that net increase or decrease is recorded in fund flow statement. Net decrease in working capital is source and net increase in working capital is application. Next step is preparation of fund flow statement. Left side of fund flow statement shows sources of fund, then right side shows application of fund. Items come under sources of fund are: first one, fund from operation. Second one, issue of share capital. When shares are issued to the public, company will get fund from shareholders. The next one, issue of debentures. When debentures are issued by the company, there is an inflow of cash. Debenture holder will make payment to the company. So there is inflow of cash. That's why issue of shares, issue of debentures, then raising of loan are sources of that firm. Then sale of fixed asset and long-term investment. Fixed assets like land, building, plant and machinery, furniture, and long-term investment are sold to generate fund, and that becomes source of fund. Then non-trading receipts. Non-trading receipts like dividend received, refund of tax also increases fund, and it is also treated as sources of fund. Then decrease in working capital. If working capital decreases during current period as compared to previous period, it means that there has been a release of fund from working capital and it constitutes a source of fund. Decrease means current asset reduces. That means these current assets are converted into cash that generates fund. Then application or uses of fund. First one, fund lost in operation. Second one, redemption of preference share capital. Redemption means repayment of preference shares. That means outflow of fund. If shares are redeemed in exchange of some other type of shares, it does not constitute outflow of fund because both are non-current items that won't used in fund flow statement. One item must be current and other item must be non-current. The next one, repayment of loan and redemption of debenture. A company repay debenture and loan amount to the debenture holders and financial institution, and that is also outflow of fund. Then payment of dividend and tax. Payment of dividend and tax also application of fund. The non-trading payment. Any expense not related to trading operation of business is known as non-trading payment. It is also outflow of fund. So fund flow is a statement which indicates various sources and application of fund. Fund from operation. Fund from operation is an important source of fund. So trading profit or profit from operation, major source of fund. Here profit and loss account shows all operating and non-operating items. All non-operating items must be excluded from net profit for calculating fund from operation. Now we will move to the calculation of fund from operation. Fund from operation only includes operating profit or trading profit, and we want to exclude all non-operating items from net profit. So for that we want to add back all non-fund and non-operating item which is already debited in profit and loss account while calculating net profit. So we want to add back these items. Then we want to deduct all non-fund and non-operating items which have already been credited to profit and loss account. We want to deduct that item. Calculating net profit, we debit all operating and non-operating expense and credit all non-fund and operating income in profit and loss account. So to remove these non-operating expense, we want to add back all non-operating expense and we want to deduct all non-operating item which was shown in credit side of profit and loss account. Fund from operation is calculated by using two methods. First one is it is calculated using statement form, and second one is preparation of adjusted profit and loss account. So first one, statement form of fund from operation. For that, first we have to find out the closing balance of profit and loss account. Then we want to add all non-operating items which have been already debited to profit and loss account. Different non-operating items are depreciation, then amortization of fictitious and intangible assets like goodwill, patent, trademark, preliminary expenses, discount on issue of shares. Then third item is apportionment of retained earnings, that is transfer to general reserve, dividend equalization fund, transfer to sinking fund, contingency reserve, etc. Then next one is loss on sale of any non-current asset such as loss on sale of land and building, loss on sale of machinery, loss on sale of furniture, loss on sale of long-term investment, etc. Then next one is dividend. Dividends include interim dividend, proposed dividend. The next item, provision of tax if it is not taken as current liability. Item, that is provision for tax, is also added here. If it is treated as current liability, it will appear only in statement of changes in working capital. These are the non-operating items which have already debited to profit and loss account. Next, we want to deduct non-operating item which have already been credited to profit and loss account. Different items are profit or gain from sale of non-current assets such as profit on sale of land and building, profit on sale of plant and machinery, profit on sale of long-term investment, etc. The next one, appreciation in the value of fixed asset such as increase of land, plant and machinery, etc. The next item, dividend received. Then excess provision transferred to profit and loss account or written off. These are the non-fund items which have already been credited to profit and loss account. And the balance is fund generated from operation or fund from operation. Second method is preparation of adjusted profit and loss account, and the balance of adjusted profit and loss account is fund from operation or fund lost in operation. If balance in debit side, it is fund lost in operation. If it is in credit side, it is fund from operation. Opening balance of profit and loss account is shown in credit side of adjusted profit and loss account. Then closing balance in debit side. Then all non-operating expense is debit side of adjusted profit and loss account, and all non-operating income the credit side of adjusted profit and loss account. Then we want to find out balance. If it is in credit side, it is fund from operation. That is about today's video. Hope you all understood these topics. Please subscribe my channel and share my videos. Thanks for watching my channel. Bye.